Have you ever sold a stock and thought, boom, I'm rich, only to get slapped with a surprise tax bill months later? Yeah, that hurts. But what if I told you the difference between keeping your gains and giving a chunk to the IRS literally comes down to just one day? In this video, we're breaking down exactly what happens when you sell stocks at a profit. The taxes, the timing, the sneaky rules that could cost you, and most importantly, how to keep more money in your pocket. If you're new to investing or just want to avoid an expensive mistake, you're in the right place. Let's go. So, you bought a stock for 50 bucks and now it's worth 75. You decide to sell. Congrats, you just made a $25 profit. That profit is what the IRS calls a capital gain. It's basically your reward for investing wisely. But here's the catch. Uncle Sam wants his cut. That $25 is considered taxable income, and how much you owe depends on how long you held the stock. There are two kinds of capital gains. Short-term capital gains, where if you sell the stock within 1 year of buying it, your profit is taxed like regular income. That could be anywhere from 10 to 37% depending on your tax bracket. Then there's long-term capital gains. If you hold the stock for more than a year, you get a tax break. Most people pay 0, 15, or 20% on these profits. So patience literally pays off. Holding on to your investments for just a bit longer can mean a smaller tax bill. So let's say you make $50,000 a year from your job and you sold some stock you held for 2 years for a $2,000 gain. That gain gets added to your tax return, and based on current IRS rules, you'd likely owe 15% or 300 bucks on that profit. But if you made the same gain and sold the stock after just 6 months, that $2,000 is taxed as ordinary income, potentially at a higher rate, maybe even 22% or more, depending on your income. So timing matters a lot. Now, what if your stock went down? Maybe you bought it at $100 and sold it for $60. That's called a capital loss. The good news, you can use those losses to offset your gains. So if you made $2,000 in gains and lost $1,000 elsewhere, you only get taxed on the $1,000 net gain. You can also deduct up to $3,000 in net losses against your regular income per year. And if your losses are bigger than that, you carry them over to future years. Yeah, losses are kind of like coupons for your tax return. Know your holding period. That 365-day mark is a big deal. Selling a day early could cost you. Keep records. Your broker will send you a 1099-B form, but it's good to keep track of what you paid for each stock, which is your cost basis. And then watch for wash sales. If you sell a stock at a loss and buy it back within 30 days, the IRS disallows the loss. No do-overs. And then tax-advantaged accounts, if you sell inside a Roth IRA or a 401k, you might not owe taxes at all. Definitely worth considering. So, there you have it. Selling stocks at a profit is exciting, but knowing the tax rules helps you keep more of those gains in your pocket. Remember, short-term equals higher taxes, long-term equals tax savings. Losses equals, not fun, but it's still useful. If you found this helpful, be sure to give this video a thumbs up, subscribe to Artificial Investment, and let us know in the comments what investing topics you want us to break down next. Until next time, I'm Jason, and remember, the only thing better than making money is keeping more of it.